Well, you probably saw the stories this week about a national housing slump, and now you're worried. Is your biggest investment about to tank? Tank, no, but it could take a major hit. The Bottom Line panel is here to help us on this one. Patricia Croft is a former senior bank executive. Jim Stanford is an economist with the Canadian Auto Workers. Preet Banerjee is a personal financial columnist and broadcaster. And Amanda Lang is ours. No one else can have her, right? For now. Their thoughts on all this in a moment, but first, the brief background. This is one of those stories where how you react depends on how you read the headlines. House prices continue to rise, 4% from last year. So what's the problem? Well, it's right here in the actual number of sales. They were down 8.9%. That is a slowdown, and it's been most pronounced over the past few months, plus the forecast is more of the same through all of next year. Now, if that doesn't seem like a big deal to you, ask the Americans.
It's like the Wild West. It really is.
While the situation wasn't identical there, the precipitous crash in house prices was preceded by a major slump in house sales. All this gives homeowners reason to pause. What are the risks? What are the warning signs? And what's the best way to protect yourself? Good questions. Time for some answers. And let's start with the big question. What happens when the housing market cools to the overall economy? Patty.
Well, in terms of the numbers, Peter, housing isn't actually that important to the Canadian economy because if you look at construction and sales, it's only about 6 or 7% of the size of our economy. But I don't think it's about the numbers. I think it's about psychology. And what I mean by that is what happens when house prices go up is we all feel really, really wealthy, we feel great, and we spend more. This is called the wealth effect. And there's actually numbers associated with this. It's estimated that for every dollar your house price goes up, we'll spend another 5 to 7 cents. So it doesn't sound like a lot, but if we all do it together, it helps the economy. But it works in reverse as well, the negative wealth effect. So as prices go down, we don't feel so good. We pull our horns in, we spend less. And if the economy is fragile, that can tip you over into recession. So the bigger effect, I think, is psychology.
Okay, Jim?
Well, there's all kinds of side effects and sort of unintended consequences when you start pulling on the string of the sweater with falling housing prices. You do have a potential impact in the construction industry, which is an important part of the real economy. You can also get some terrible things happening in the financial sector. Housing prices fall far enough, you could see some homeowners who are underwater in the sense that their home isn't even worth as much as they owe to the bank. And that's when they start thinking, well, maybe I should just default. Many people default, suddenly the banks have loan losses. Banks have loan losses, suddenly they start tightening credit, and then you do feel that throughout the whole economy. So the side effects of what can start, and as Patty says, a relatively small part of the economy, can really ripple through every bit of the economy.
You know, you don't look so tired for a guy who's been up most of the week.
Caffeine does marvels.
The viewers should know that Jim is on the CAW negotiating team and has been working on those various negotiations with the big three.
So if I fall asleep in the middle of the panel,
don't do that. Preet, the overall economy, the impact on all this.
I think the impact is if you have a lot of home equity line of credit spending disappear, because that's where a lot of spending has come from. The people are basically using their homes as a bank machine and taking money out. And a lot of it is on renovation, which is increasing the value of their homes. But a lot of it is also a little bit more conspicuous, big screen TVs and vacations. And of course, if this spending goes away, what's going to replace it? Which echoes what Patty says could put us into a recession.
If we have too much debt, that's a good thing, though, isn't it?
Yeah.
Good and bad. I mean, I would echo all of that. The spin-off industries are important, and so it's everything from construction to finance to big appliances. There's all kinds of things that get a boost from a robust housing market. The real risk, remains those people who are in over their heads, people who are living at the edge, who don't have much equity in their homes. It doesn't take much, either rates going up, prices coming down. The two can happen together for those people to be in serious jeopardy, and then that obviously has an immediate ripple effect across the economy.
All right, well, that brings us to, to ground level, to people like us who own houses, watching the slump take place. What's the risk for them on a personal basis? Preet?
Well, I think that if housing creates a recession, which is possible considering that because there's been a boom, there's a lot of people who've been attracted into real estate associated industries like construction, real estate agents, mortgage brokers to give you a big fat mortgage. And of course, if there's a cooling, then that could affect those people. So with a lot of people out of work, that puts the economy into recession, reduces spending, could affect other people as well.
Amanda?
Yeah, I mean, the real problem is those people who have, and pre-alluded to the lines of credit, the real borrowing that was the bulk of the borrowing in the 6 months before Jim already tightened up all the rules were people who had already borrowed to the max. It was the people who were already on the edge who were borrowing even more. That's a real at-risk category. And what happens to them, where they go, are their jobs also more at risk than other people's jobs? It's a very fragile group that we got to watch closely as all of this turns.
You know, most of the country, when we look at those numbers, is showing the slump, but not all parts. Manitoba, Alberta, Yukon, the house price is still going up. The slump's not kicking in there, at least not yet. Is there a risk when you're in a boom area as opposed to a slump area?
Well, real estate is all about location, Peter, right? Location, location, location. So I think if, for example, you're living in Calgary or Edmonton, this week the conference board said those two cities have the best outlook, not just this year, but for the next 4 years. So if you're living in cities like that and in the Yukon, where there's tremendous demand for housing and not enough supply, then the price may continue to rise and housing could be a great investment. So I really think you can't make generalizations. You have to take it on a case-by-case basis. But indeed, if you're living in a part of the country where you're fortunate enough to be in a boom, then housing right now, even though prices are rising, could still be a great investment.
All right, let's get to how we try to protect ourselves. What's the advice? What's your number one advice to those at a time like this on how to protect yourself?
Well, it's pretty tricky for an individual to protect themselves against all of those macroeconomic side effects. To start, you should just be prudent. If you're thinking about buying a house, make sure that it's a house that you want to live in and think of it as a place to live more than as a speculative investment. Make sure that you're getting value for money, so you're not buying into an overheated market where the prices are simply far too high. And make sure that you can cover the interest costs, even if the interest rates go up. If those don't all apply, then think about renting for a while. Renting is actually a pretty good deal right now.
Is it?
Yeah.
Rental prices come down?
They haven't, but they have not gone up as fast as the ownership has. So the ratio of owning a house to renting a place is out of whack. So relatively speaking, renting could be a good deal if it suits your life. I think the house, first and foremost, is a real place for you and your family to live as opposed to a financial investment.
Amanda?
Well, I think the most important thing that any of us can do is get an envelope, back of the envelope calculations. It doesn't have to be fancy, but play out some scenarios. Interest rates could go up 6%. That could happen. We could get serious inflation, and our central bank could have to hike rates severely. And people should remember that whatever they're locked in at, you have a term on your mortgage, and the bank can do whatever it wants when that term is up, usually 5 years. So it could be a big reset to the upside, and just run the numbers. If you can't afford it, it may actually be worth thinking about getting out ahead of that. In other words, while the market still has a selling side to it.
Mark Carney hiking rates?
Not quite
Those
yet.
two things don't go together.
They will one day.
They will one day. He's desperate to, believe me. Can't you tell? He's champing at the
He just
bit.
wants to.
The
Right?
minute that he can, he will.
Preet, advice.
I think Jim hit the nail on the head. You can't control what you can't control. What you can control is your own individual situation. So that means getting your ducks in a row. So building up an emergency reserve. If, in case there is a recession and you're at risk of losing your job, you need to be able to pay the bills in the meantime. You want to pay down debt aggressively and basically do the things that you're always supposed to be doing with your personal finance. But I think some people have been able to do they've been doing things that they shouldn't be able to do because of the increase in house prices that allowed them to do that.
And if I hear ducks in a row one more time in this hour, your advice.
My advice, get your emotions under control. Real estate is a fascinating asset. For most of us, it's the most money you're going to pay for a single thing in your entire life, and yet you buy it on a gut reaction the first 5 minutes you walk into the place. So my advice would be to get your emotions under control. So have a budget and stick to it, and maybe take your mother-in-law with you, take Kevin O'Leary with you when you go to buy a house to get that under control.
You really want to do that?
Not me personally, but my son and daughter-in-law last fall bought a house in that crazy market. They were outbid many times, but they had a budget and they stuck to it. Because the problem is, in the heat of the moment, you're going to bid that extra $10,000, $50,000, or $100,000. You'll end up with a house, but you may also end up with buyer's remorse. So try and take emotions out of the equation, as hard as that is.
You know, in the setup pack, we recognize that there are major differences between what happened in the States and what's happening here. But in terms of similarities, are there significant similarities in the two stories?
Well, the housing market in Canada now, by most indicators, is as overvalued as the U.S. market was before the crash. In fact, by some indicators, it's more overvalued. So in terms of the actual level of prices and how much it's come up in the last few years, despite our really kind of lackluster economic situation, I think we are kind of precarious. There's other factors that, of course, make us more stable.
I think those numbers are so skewed by Toronto and Vancouver that I think it makes no sense at all to look at it on an aggregate basis. You've got to drive it down to individual markets, and Toronto and Vancouver are now cooling quite sharply.
And the truth is that the capital underpinnings for our market is completely different. We just don't have the kind of derivative products that they had. The mortgage-backed securities became a cottage industry that then fueled additional home buying. None of that goes on here. It's a very small piece of the market. Our banks are very, very, very conservative.
And one key difference in Canada has been the role of government, actually.
Yes,
you know, we've got the CMHC, the Crown Corporation, that does public insurance on mortgages. Then because they are insuring it, they also tie it to the standards on the quality of the mortgages in terms of how much you have to have down payment, how quickly you have to pay it off. We've got different role of government around interest rate deductibility. So the role of government has been a very stabilizing force in our real estate market. I suppose Mitt Romney won't like it. He probably thinks Canadians are 100% dependent on government instead of 47%. But if it works, it works, and it has in our housing.
Where are you on this, Preet?
Well, I just want to throw in my 2 cents on that. I think people have identified that Toronto and Vancouver are overvalued. And that would indicate that there's an irrationality of prices versus what the fundamentals would suggest. And I've heard a lot of people say, okay, there will be a correction and it'll come back down to where those fundamental values should be. But I think it could overshoot that. So if you can be 15% irrational on the upside, you could easily be 15% irrational on the downside. So I don't discount the possibility of a crash. I don't think it's likely, but there is a possibility.
When you look at what happened there, recognize the differences, is there a lesson, though, in what happened there for Canada?
The lesson is that we shouldn't change what we're doing. I mean, to Jim's point, we have this insurance scheme. It's a way to spread the risk to all taxpayers, whether you like it or not. It keeps us safer. And we just don't have the mortgage-backed securities. I mean, it really, I think even if there's a crash, it'll affect a part of the market. But if you're in your house for the long term and you can afford your mortgage, crash doesn't matter. It's just a paper difference in your wealth. And as Patty says, you know, get control of how you feel about that and you'll be fine.
I think the difference, though, in the United States, they turned a blind eye to what was going on, whereas in Canada, I think the regulators and the federal government had done a masterful job in really heading this thing off. So I think Canada is going to be the only country that will safely deflate some overvaluation in their housing market. That'd be another feather in our cap, and it's why we have a AAA credit rating.
Great.
I'm still worried. Again, you know, irrationality is just that. It's irrational. So prices can go below what they should be. And that's what scares me. And that does pull down a lot of, again, real estate related industries, could put us into recession.
Lesson?
Another lesson we've got to learn in Canada, if things do go south, so to speak, is to stop the problem of foreclosures and evictions before it gets started. If there's one thing that's just made it a mess in America, is this self-exaggerating process of people getting thrown out of their homes because they can't pay the mortgage, and then the homes are vacant, and then that drags down the prices of everything around them. It's a social and economic disaster to throw people out of their homes. So if we get a problem like that in Canada, we've got to find a way to forgive debts and keep people in their homes. That will be beneficial for stabilizing the whole market, and that will require a government role as well.
All right, got to stop there for a moment. Don't go away. We'll be asking this question when we come back. Are there opportunities at a time like this? Well, the bottom line returns. And welcome back to the bottom line. Patty, Jim, Preet, and Amanda are all at the table tonight. So let's talk a little bit. We've talked about risks, problems, opportunities. Are there opportunities in a market like this, Amanda?
Well, there'll be obvious opportunities as the prices soften. So it's already started to happen, as you noted, in Toronto. It'll happen in Vancouver. The question is to what extent. But there's also, for people who still own their home, but need the equity. I mean, Jim says, you know, you have it to live in, not to invest. But for most people, it's a sizable chunk of their retirement planning. If you need that money soon, you still have time to sell. And I would, you know, without giving anybody advice, I would say there is a window here where if you can relieve the tension and take that money out, this is a chance to do it.
So you would say there are selling opportunities out there.
Selling opportunities.
Remember the guy who said there are buying opportunities out there? That wasn't a good remark. Preet.
Well, I think speaking of buying, if you're a first-time home buyer, maybe you had a budget for a house that was $300,000 and there's some kind of correction. Maybe that house is $270,000. That makes that house much more affordable. The thing I'm worried about is now that person's going to say, well, what's fallen to $300,000? I'll just buy that house, right? So the mentality may not shift, but if you can pull back the reins and get into a house responsibly, there's an opportunity there.
Jim.
Well, here's an idea. I think there's a national opportunity out of a housing correction. You know, we've had this red-hot real estate market, yet there are still millions of Canadians who are underhoused. And if it turns out that private construction declines, there won't be as many condos being built and everything, let's take some of those resources and put them into building nonprofit, low-income public housing, co-ops, that kind of thing, where we can actually get some of those people who didn't get into the real estate boom into housing. That would be another way to keep the jobs in construction, and also, again, to stabilize that roller coaster that we've been worried about.
Seeing any indication from governments they're interested in that?
Perversely, the federal government is actually, it's called a step out. They're actually pulling right out of the nonprofit housing industry, even though they have the money. And I'd say that we have the need.
Patty.
I was going to say that. Good luck in terms of actually having it happen. But
Yeah.
I think there is a buying opportunity here, Peter. But again, back to my point about emotions, don't rush. There is a lag between a drop in sales and a drop in prices. It's usually a couple of quarters. So don't chase this bubble mentality that's still out there in some markets. So wait. You're never going to be able to pick the bottom, just like stocks, but let prices soften a little bit. Stay on the sidelines, rent, and your opportunity will come.
All right. A quick round the table on what to look for. What's the best indicator to try and gauge what's happening in the market? Great.
Well, there's a lot of them that are saying that, our correction is going to be prolonged, but that hasn't happened. One of the indicators that I look at is inventory. So that's how long it would take to clear the total amount of listings on the market. And those numbers are increasing, which is a bad sign for real estate. And they also are accelerating.
Jim.
The one I would watch with great concern is defaults and foreclosures. If you see a lot of people, for one reason or another, defaulting, the houses having to be sold, that's going to be bad for the families that lose their homes, bad for the banks, bad for the economy.
Patty.
I have a very technical one. It's chit-chat. I think if you go to a cocktail party or your kid's hockey game, if everybody's talking about real estate, buyer beware. If you hop in a cab and the taxi driver wants to talk real estate, buyer beware. But my favorite indicator, Peter, I saw a couple of weeks ago walking my dogs in Oakville. I saw a for sale sign, and underneath it said reduced. I haven't seen that in years.
No.
That's a sign that house prices peaked in May or June.
How many dogs?
Just 2.
Okay.
There's data available for every region, and because real estate is so specific to where you live, CREA, the Canadian Real Estate Association, puts it out, TerraNet and others like it, and municipalities put out numbers. The pace of sales and the prices are the two things you watch. We've seen sales drop, but prices hold. The next thing to go, of course, is prices follow and sales drop. The question is, by how much? By how fast? That's just Toronto. It'll be different for Winnipeg and Saskatoon and Brandon. So get those very specific local numbers.
There are averages usually for times of booms in houses and slumps in houses, but the most recent boom was so long, people aren't trying to put a figure on how long this slump may last. All right, thank you all. Always good to hear from you on your advice on these things.